As expected, the Chancellor's continued to take a strong stance on tax avoidance, particularly in relation to cross-border business. This comes as no surprise, really, following on from the recent publication of the OECD recommendations on how best to tackle base erosion and profit shifting. In relation to hybrid mismatches, which fall under Action 2 of the OECD's recommendations, the Chancellor announced today that new legislation will be introduced with effect from 1st of January 2017. Very broadly, these new rules will target arrangements whereby a tax-deductible expense is taken twice in relation to the same expense, or there's a tax-deductible expense with no corresponding taxable receipts. Turning to Action 4 of BEPS, the Chancellor announced today that new rules will be introduced with effect from April 2017, which will restrict the deductibility of interest in the UK for large businesses. The main target of these rules are large multinational groups who borrow heavily in the UK in order to fund their overseas operations, and yet are still able to claim deductions for tax purposes in respect of the interest paid from the UK. The general rule here is that the restriction will be set at a level of 30% of the group's UK EBITDA, with various exemptions expected to apply. We look forward to seeing the draft legislation in this regard, and particularly the extent to which special rules are introduced for the banking and insurance industries. And one more key point to note is that UK withholding tax rules in relation to royalty payments will be strengthened in order to prevent profits being shifted offshore.